everyone. In this tutorial video, we'll be learning about income statement. So what exactly is an income statement? Income statement, it is a summary of a company's profit and loss over a specific time period.
Let us take an example of income statement in a company. The thing which I wrote is the pro forma of an income statement. Whenever you sell a product to a customer, the money which you get from the customer is termed as revenue. Revenue is different from income. We can take the example of a company which gets revenue of around 50 lakhs. The cost of goods sold must be deducted from the revenue. The cost of goods sold, also known as COGS, is the cost incurred for producing the product which we are going to sell. This cost of goods sold comes under two categories such as fixed cost and variable cost. An example of fixed cost is the rent paid by the company, and an example of variable cost is the energy used for production. And in this example, we can just take the COGS as 10 lakhs. We are deducting the COGS from the revenue, and we are getting a sum of 40 lakhs. This is termed as the gross profit.
This number, that is gross profit, will tell you how much money, that is how much profit we will make by selling our product in the company. And this is the profit before all the other expenses the company has to incur, that is wages, salaries, etc. And we can broken off all the other expenses in the company to three parts, I think. Three parts, that is, first one is marketing expenses. And the next one is sales expenses. That is, we have to face so many salespersons during our work. And the other one is the main important one, that is G&A, that is general administrative expenses, which includes the CEO's salary and the payment of the hiring of an auditor and the accounts payment, etc. In this example, let's take the marketing expenses as 5 lakhs. Let's take the sales expenses as 3 lakhs. And let us consider the G&A as 2 lakhs. By excluding all these expenses from the gross profit, that is 40 lakhs, we will obtain 30 lakhs. Which is the operating profit of the company.
Before we go ahead with the calculations, let us talk more about gross profit and operating profit. Now, operating profit is the profit which is earned by the company from the operations of the company, and gross profit is the profit which is earned by deducting the cost of goods sold from the revenue. Now, all economists are of the view that the funding of every company is the same. Some companies do have debt, but some companies do not have debt. In this case, let us assume that the company has an asset of worth rupees 10 crores. And the company pays with it of debt, say rupees 15 lakhs. And also the interest rate of the debt is 10%. Now, coming back to operating profit, this is not the profit that has to be taken home by the company. In fact, operating profit will have to be deducted with the interest on debentures, that is 30 lakhs as the operating profit minus interest expenses. Now the interest will be treated as expense in this case, which is 10% of 15 lakhs, which is 1,50,000, which amounts to 28 lakhs 50,000, which is called the earnings before tax.
EBT, earnings before tax, is also known as pre-tax income. It is the money earned by the company before paying the tax to the government. So the next step is to reduce the tax from EBT, says 30%. This is the net income.